Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is August 29th, 2024, and we're going to talk about consumer spending and energy. Now, when we say energy, we could certainly say maybe consumers are running out of energy and are not going to be spending more, but we're talking about oil and energy and the correlation of the overlap with consumer discretionary spending. To start with, we're going to talk about this move today. Today was a kind of a wild move. We had a significant rally, a significant sell-off. We actually dropped all the way back down here, sub yesterday's close, and then recovered most of this in the after hours. And you can see that on an intraday chart on the ES. You can see there's your start, there's your huge rally, there's your huge sell-off, and we recovered most of this from that low, about 55.97 to 55.28 in the last hour, and pushing higher up into the key level. Now, as you can see, we're still drifting higher slightly, but for that rally from the close of yesterday to the open of the trading hours today, we had a significant gap. So the rally was really a recovery in the overnight and a rally in the European market. This is where the US opened. We climbed higher, sold off more than what we opened with, and so the candle really is below the cash open. This is not a great bullish day, even though that individual candle looks like it's a bullish candle. It's really not a great bullish day when you take into consideration what it looks like in the US trading hours. So this could be an indication that overseas money is what is driving the market in the overnight. If we look at the S&P 500 when it comes to just the regular trading hours with the SPY, you can see there's a gap up, trade higher, close down, and really we closed at yesterday's close. Not super convincing, not super bullish to me, and that has me looking again to say, show me the extremes. Show me where we'd expect the market to recover and rally. To do that, let's talk a little bit about today's announcements. Economic announcements. We had preliminary GDP, which is the second of the GDP reports. You have advanced, preliminary, and final. Advanced has the biggest impact as far as the market's reaction and behavior. Preliminary is more data, more solidifying of the advanced. And the final is, okay, now we know really what we did this last quarter, and this is the final number, but we've already reacted to it. We've already priced in the expectation by the time we hit final. So this preliminary GDP going from 2.8 to 3.0 is a sign the economy isn't struggling, at least according to GDP. And therefore, do we need a cut in rates? The Federal Reserve commented that they would not cut rates unless it was necessary, and they would cut rates as necessary. Well, this would seem to say it's not. It's just not necessary. We're at near record highs in equities. We're at GDP climbing at 3%. They say inflation's under control, but that's not the justification to cut rates. It's whether we need to cut rates to stimulate the economy. That's really the historic behavior of the Fed, and that's not what we're seeing. So we're still pricing in those rate cuts. Look at pending home sales, though. The pending home sales dropped negative 5.5. That is a major miss from pending home sales. We know that housing is struggling, and maybe that's the reason why we're going to see more intervention from the Fed by cutting rates again. And I showed this last week. This is consumer loans and credit, and all revolving plans of all commercial banks. We have seen a move again of 500% increase from 2001 to now as far as consumer loans and debt. We've gone from $200 billion of U.S. debt at the consumer level to over $1 trillion, $1,063,000. Now that was last week, so we can probably get an update here on this. And let's see. Oh, what do you know? It's even higher. So we are continuing to borrow. We're continuing to push it higher, and we're even pushed an extra few million in there just for fun in 1 week. So we're adding and adding and adding to consumer debt, and it's pushing to higher and higher numbers. Now we know that consumer debt, as we talked about last week, consumer debt is being spent on consumer staples, not on consumer discretionary. If you look at the market today, really, we saw equities recovering and trying to close higher. We saw NASDAQ trying to push higher, the S&P pushing higher, the Russell pushing higher, and actually doing quite well because of financials. But we did that with Nvidia falling. Nvidia fell over 6.3%, so almost 6.4%, and that's been the biggest push behind equities pushing higher. So when we look at that, if Nvidia, which has been the darling, the one that's lifted the entire market, falls by 6.4% roughly, That means today alone, Nvidia lost about $192 billion worth of value in just today's move. 192 billion in value that dropped today. And it created what I would see as truly lower highs, lower lows, lower high, lower low, lower high. Are we going to just retest the low? And a retest of the low would push us all the way down to 91. And then we're talking about an additional 14 to 15%. So we could see another 300 to 400 billion dollars go away out of Nvidia. And if this is what was holding up the market, what's going to hold it up now? Well, today we saw some real strength in Visa and MasterCard. Visa pushed up into these levels. This would be the assumption that the financials are doing well and a good representation of how consumers are spending. Do we really think that consumers are spending more? Visa primarily makes its money from transactions. If credit cards are at record highs and we're seeing those defaults, I would not be betting on more transactions. In fact, I'd be betting against that consumer discretionary world and looking for failure here. If you look at consumer discretionary, we did the same thing that we did in S&P 500. We gapped up, traded down, and ended near yesterday's close. This is also off of the previous highs. This is actually more bearish than what we just saw in the S&P 500. Consumers are not backing this up. One thing you should also be aware is the Home Depot and Lowe's, but Home Depot even more so, is a really good representation of the health of the consumer. Because whether we're buying homes or building homes or repairing homes or doing it yourself, all of that helps Home Depot go higher. We're not pricing in Home Depot higher right now. We're actually reversing off these highs. We've failed on this breakout. You can see we pushed through the high, but we closed back inside. We never closed above that previous high. So to me, this gap up, close down is a failure, piercing line into there, going all the way back down here. And if we break through 364, we should see 350, 350, 345 over the next couple of weeks. Home Depot could be just the first warning shot. Now, if we look at Home Depot and we look at the options on Home Depot, you would see that Home Depot's options are very inexpensive. They're 26th percentile, and it might be an opportunity to do an in-out put spread to target back down to that 355. But Amazon is another one that seems to be a pretty good representation, at least based off the number of boxes that are at my house that have the smiling Amazon face on it. This is a good representation of consumer spending as well. We've got lower highs, lower lows, bear flag, and then this recovery rolled over without filling the gap. And we rolled over with energy. And we continued today with a gap up and a close down. And this gap, we're back through it. So anything below this gap, right through here, I would say is going to be a continuation back down to this gap. So I'm looking at Amazon as possibly a $10 move lower and retesting all the way down to 162, maybe 160. I'm not necessarily thinking we're going to reverse through this, but we're going to probably go test it. That tests the last earnings spike. Now, current implied volatility here is about 38%, so not super high, not super low, but this would probably be a good in-out spread type of trade to buy an in-the-money put, sell an out-of-the-money put, so you end up with a net positive time decay, looking for that next move down. And part of all of this as well is watching energy. Remember, the energy prices will have a direct impact on how consumers spend as well. Not just how they spend because they have to spend money at the pump, but if it's going higher, they will probably have to spend more money on flights. They'll have to spend more money on any plastic, any oil-based product, and delivery of said products to their home or to the local stores. So transportation costs go up as well. Crude bounced up pretty good here. But as we look at this in conjunction with the long-term trend, today's bounce seemed like it's already set up for failure. We did the same thing here. Traded up and trade back down. Not bearish enough that I want to lean into a super bearish trade, but certainly showing me some weakness in crude, and demand remains low. Higher price, demand remains low. Now this is retail gas futures. And retail gas futures, we had a gap down, close up. That is showing a lack of demand as well. And normally we don't get that kind of gap even on contract changes, but occasionally you'll see a small gap on the contract changes. I've adjusted this for contract changes and it still shows the gap through here. But normally they're not that big. This is a more significant gap down. Theoretically, you and I should be paying about $2.70 at the pump if you add in federal and state taxes in there, it should be this number, 204, 211, plus your federal and state taxes, but we know that's not the case. Gas prices are still high, which means that the energy companies are still charging us a bit more than what they need to based off their margins. So as we're looking at this, this is still a lack of demand, still retail gas prices falling, still holding down the lows, and I've already shown copper before, showing that as an indication of falling or low demand in the consumer's world. Which, at the risk of being repetitive, I still like utilities. If energy prices are low, demand is low, consumers are fatigued, consumers are leveraged up, consumers are spending on the base needs, utilities are likely to still hold up. Now, we did have a significant sell-off today, but a full recovery. So this is a gap up, test lower, but close up. This is not failure with a gap up, close down. It's a gap up, close up, which says there's probably more upside to utilities. And if energy can't move higher as far as crude prices go, natural gas prices and retail gas prices don't go higher, utilities will continue to make their margins and continue to pay out their dividends. This still looks very promising as a continuation higher. If we're to look at the subset inside of XLU, a couple of things to be aware of. Nextera is number 1, Southern number 2, Duke number 3, and CEG. CEG is one we talked about a couple of weeks ago, and if you're looking at CEG, you can see it's just holding and hasn't really broke free of this, but we created a widening pattern today. It means it's anyone's game, but I would look for a break above 200 to go up to 220. So there's a 10% move that we could trade into that if we just simply clear the high. But the nice thing is a widening candle also gives us our stop loss. If we create a widening candle and clear the high, then the widening candle's low is all we have to risk. Now, let's get real specific. We're talking about 199 versus 192. We could get away with probably a $7 risk for a $21 reward. It's a 3-to-1 on CEG, and where we can actually collect a good dividend on CEG as well. Nextera looks very close to XLU because it's the largest component, so let's take a look at Southern. Southern's pulled back a little deeper. It is a gap down, close up, and it filled the gap and closed inside the gap. It is a hammer, and so a simple trade above this high would give you the same kind of idea. It's not a widening candle, but it is a hammer, hammering out possibly a base on Southern. And if it's hammering out a base here, could we go back up to 88, 89? Yes, it's only 5% move, but Southern also has a 3.36% yield and 41% on its dividends, and also 41% implied volatility on its current options. And so if you buy here and it gets up to 88 or 89, we could sell those previous highs. And if we sell those previous highs, call as we approach that call near at the money, you would collect an additional $1 to $2 of premium as you reach up close to that 88. And that way you could walk away with possibly $4 in directional move, a dividend, and another $2 in the underlying stock. And what it really comes down to for me is comparing XLU to XLY and looking at these moves and these behaviors. So XLY has certainly had a nice recovery off of these lows and pushed up here. But when we look at the big picture, you can see that XLU has outperformed consumer discretionary all through April, again through June, and this recovery has been great, but we're starting to sell off those solid candles here and climb here. If you look at the price ratio, you can see that that ratio has increased through here. That is utilities winning and consumer discretionary losing. Here is a correction, but then right back into this, we're in an uptrend for utilities and a downtrend in consumer discretionary. And as long as this is above that yellow line, this trend is likely to continue to push towards those directions. And that's what we want to see. We want to see that opportunity to continue to buy utilities and sell consumer discretionary as long as those are up. If they cross down, then we can flip the script and go the opposite direction. But that's going to do it for me today. Join me again tomorrow with Brandon. We're going to talk about other reasons, 3 different reasons why today's move could have been the top, meaning the lower top, lower high. We'll talk about that and some things with economics, some fundamentals and technicals that are going to help us understand where our next move is probably going to be. And we'll get into some discussion about deficits and credit card debt and more. So join us again tomorrow morning. Thanks, everybody. Have a great night.